go.
Streaming from South Africa to the world. This is the Stonks Go Moon podcast. What just happened? We break it down so you don't have to.
Welcome everyone to the Stonks Go Moon podcast. My guest today, very special guest, David Belle. He is the founder of Macrodesiac, and he is the something to do with growth in Tradingview for the UK. Something to do with that. David, welcome to the pod.
Hi Rocco, mate. Nice to firstly meet you, and secondly, thanks for having me on.
I mean, Macrodesiac is where I know you from. Probably a good place to mention that I'm more of a pro real-time guy, just to get that out of the way so that there's no conflicts between that and Tradingview. Let's kick it off. You wrote an article the other day called Zero Lower Bound. It's something I think Alfonso Percatiello has been on my pod to talk about. You go into depth a lot more than he did. What is zero lower bound and why does it matter?
Well, so the zero lower bound is essentially when you reach 0% interest rates, right? And when you get that low is when QE has to kick in, because effectively lowering the rate of interest no longer works sufficiently because you enter what's known as a liquidity trap. I'm not going to explain what a liquidity trap is because it will bore the life out of you. It's basically, whether people have a preference for owning bonds versus cash, that kind of thing, and what effects that might have in the economy to stimulate or But there's kind of like a relationship there when we do get to the zero lower bound where economies become much more inefficient. You might have heard about misallocation of capital when rates are so low, when QE occurs. I mean, we've just seen, the really, really high growth stock basically bubble explode, the high growth tech stocks. Some of these firms had priced earnings ratios like 300-400 with no real validity. So when we get to the zero lower bound, it becomes a real conundrum for policymakers because essentially there's a balancing act between, okay, we need to stimulate, but also there's that secondary effect of malinvestment, all of these other issues that actually have a much longer lasting effect in the economy. And by trying to stimulate too low for too long, they just kind of exacerbate this effect. In Europe, for example, it's been going on for a long time now, probably since just after the great financial crisis. So it's a real big issue, and one that they have to contend with now.
How far are we from that scenario?
Well, we're there now, aren't we? Because we've just got off of it, but the problem now is that what is the upper limit to what the Fed can go? Some are pricing, 2.5-3% maybe as a neutral rate. We heard Powell just yesterday say that they're willing to go restrictive, right? Which obviously would be an absolute dent for risk assets in the longer term, but in the short term, but in the longer term, becoming restrictive possibly might reduce all of this inefficiency, I think I'd like to call it. That's the best way of putting it. But we have had obviously lift off from 0%. They're looking to reduce the balance sheet. We're up now at 1%. So we're trying to get up there, and it's a good thing, I think.
We used the word shrinkage quite a lot during the FOMC yesterday. We used to have powerful tools. And now we went from powerful tools to shrinkage, which tell me it's a clear narrative change from the Fed.
Yeah, it's a massive, it's a big hawkish pivot. And I think that, the way that the market is really, really funny because the way the market works is obviously they've taken yesterday's speech as, a miss on the hawkishness that many were expecting, 50 basis points could be seen as dovish, even though it's not, right? But there is a clear pivot here. And I think Powell is trying to, and he did mention the soft landing. I don't think it's possible, though. I really, really don't think it's possible. because we're going to get to that stage pretty soon, I think, when credit starts to really, really, lift off. And I don't think it's going to be, the issues aren't going to stem from US credit or anything like that.
Yeah.
The issues are likely going to stem from, the massive Asian markets,
Yeah.
which, have so much capital involved in them. They're obviously related to the dollar in terms of dollar bonds issued. But also, they're still quite opaque too at the same time. So, I think there's going to be a really, really big repricing of Asian risk.
It raises two interesting questions there. The one about Asia and the other one about rates. And I think let's go the rates first. Yeah. To what extent do you think future rate hikes have been priced into this, this tech sell-off?
This is the thing with, I think, listening to what a lot of people on Twitter, for example, say, is that they say things are priced in, but a lot of people are looking at 1-2 hours after the announcement. That there's real effects of rate hikes that I think FinTwit and many people in the financial sphere forget, in that balance sheets, debt becomes more expensive.
Yes.
We've just seen Apple do a buyback, and that's really to lower the working average cost of capital. And these are real effects that occur. People are going to reprice risk premium. Yes. They're going to reprice term premium, and these things do matter. It's not just like, oh yeah, power was a bit more dovish than we expected, so markets are going to go up. Yes. No, things have real effects on bottom lines, and what's going to happen in the next 3 months, likely with these rate hikes and repricing interest, whatever I've mentioned, is that margins will thin because you've got demand slowing because of rate hikes, but also you've got the cost of that cheaper debt now increasing in price. So there's only one thing that can happen, and is that things go like that. And the big thing about 2021 was massive earnings, right?
Yeah.
Obviously, there's only one way that can go, and we've already seen some earnings slips in Q1. Apple luckily did well.
I mean, and it's a little slippage. I mean, it's not big numbers, and they're getting severely punished. Like Lyft was almost murdered. You know what I mean? It's like, so, I mean, the ramifications of missing earnings is going to be huge. Let's go to my second point about Asia. And for me, there's two themes coming out. One is supply chain, looking at what's happening in China. I mean, the Fed can't, through policy, fix supply chain as much as they want to say that they're doing something. I mean, the risk of supply chain disruptions, I mean, it's still there, yeah?
Yeah. No, absolutely. I think, even at the moment, I think it might have been Beijing. What's the date today? Is it the 5th today or the 4th?
Yeah. I don't 5th. Even know.
I don't know either. But
it's the 5th. It's the 5th. Yeah. It's the 5th.
But I think they'd shut most restaurants from the 1st to the 4th.
Yeah.
So that's showing that in China, there's still appetite from the CCP, not necessarily from, people at all. There's been horror stories about the Chinese people and what they've had to endure. But from the CCP, there's appetite for lockdowns, and they're still very, very sensitive to COVID. I don't know if it's to try and get the rest of the world to have an appetite for lockdowns again.
That's the tinfoil hat part. That's the tinfoil hat part, right? Because as soon as you start talking about that, you start talking about conspiracies. And that's the second one. That's the second main point that I have is Bill Gates came out and said, there's a chance that COVID might not be over, right? He put it at a probability of 5%, which is, it's not zero, it's not 50 or 60, it's 5%, that we might see a variant or a subvariant, that we have Omicron now, that might be something else, and we might go into lockdown again. I think that's my biggest fear at the moment, that the unknown, right? That if something comes out again and this thing mutates, right? And what we have isn't good enough, given what we've gone through, that it would be a catastrophic event.
The thing is, though, is that, we are much more liberal than China.
Yeah.
And I just don't think there's any appetite from anyone really to go through lockdowns again. It's very, very different in China, where, the CCP is kind of a mafia. and they just decide what goes. You know, they can probably set the bloody price of whatever they want if they wanted to.
Yes.
It's a very, very different environment. So I don't think we can really take example from the CCP on this one, even if they want the rest of the world to follow them. I think, there's absolutely no appetite for lockdowns whatsoever. You know,
I can't see the Americans going, no, we'll do that again. I mean, even in like Florida, they didn't even 100% do it the first time. So why would they care now?
And also in a midterm, you know, I think there's just no way Biden's going to lock down again with a midterm going on.
David, before I let you go this morning, I want to talk about the DAX, which, if you know, for the average intraday trader, I think that's, if you're on that Euro time zone, that's sort of where you stay or where you learn, and then also sort of your bread and butter trades, especially in the morning. Lately, the DAX, and I mentioned on one of your tweets that the DAX is printing candles like a toddler. There is just no volume. Distribution is rubbish. What in your opinion technically is going on with the DAX and the Germans?
Well, I think generally, you know, if you look at even the ES liquidity profile, it's really thin as well. So, and that's the largest market in the world pretty much in terms of equities indices, right?
Yeah.
And so if that's quite thin, then what's the DAX going to be? Now, I really like the DAX because I think it's far less competitive.
Yeah.
It's far less competitive than the ES or the NQ or you know, the US indices.
Yeah.
And I think it tends to behave nicely.
It does.
But then sometimes you can get an absolute ripper, you know, and I get absolutely shafted on it.
Yeah.
I think as well, there's actually quite a cultural thing with European indices, where, you know, I think it's more. Germans, for example, don't like to take risk. You know, they're one of the biggest cash hoarders in the whole bloody world.
Yes.
And that's it's quite interesting when you consider these factors, when you are looking at different indices. You know, it's probably why US indices go up so much. But I think, the DAX is just very, very slow. And it's almost like it's waiting for the ECB to just turn hawkish. That's what I think. It's literally just sitting there, you know, just around 14K, just below a little bit. Just above right now, actually. Just waiting for the ECB to turn hawkish. And, you know, I've been trading in and out of it since February. I just thought the proximity of the DAX to that conflict was just the right trade to be in. Hadn't gone anywhere through the whole of 2021, similar to the Russell. And it just had the same profile as the Russell, even though the Russell dumped a bit sooner. So I was like, it's going to do the same thing. And I just don't think there's very strong German companies. You've got Mercedes coming up with their massive lawsuit that I think they're going to get hit on for the diesel stuff or fuel, whatever it is. It's just not been a good few years for Germany as well. And I think, you know, it needs to face some music. You know, we saw German orders today down again 4.5%.
Yep.
It's a bit crap, to be honest. Just waiting for that.
Well, patience is power, and patience is a virtue. In the short term, where do you see the opportunities? Let's say in the next month or two. Where are the good trading opportunities? If you would be so kind to highlight one or two.
This is a tricky one. I'm short the DAX. I'm short Euro Swissy at the moment. It's very, very difficult to say, you know, because I think leading up to the next FOMC, we've stopped the blackout period now. Yeah. So we've got people like Bullard who can come in and totally, you know, mess up this rally that we've seen in the ES.
What is he going to come out and say? 100 basis points? Most probably.
Well, he could do. You know, he's an Uber hawk, isn't he?
Yeah.
But I think, you know, there's some opportunities in FX land. Okay. Specifically Euro Swissy.
Okay, that's
considering the Swiss National Bank has also, you know, they've cut their portfolio down in the Nasdaq. Yeah, which is a very, very interesting play. And, you know, I think bonds are due an uplift there as well, because I don't think the Swiss National Bank is going to fully repatriate all of their dollars to Swiss francs. I think what they might do is take their holdings, put it into US Treasuries, especially with the yield they can get now. And I think, partly repatriate as well. But yeah, I like Swiss franc, and I like Treasuries as well.
Well, I mean, I guess that to encapsulate, we are in a wait and see period, and if that's exactly what you need to do, is you need to wait and see.
That's it. Exactly. Patience is a virtue, as you said.
Yeah. David, thank you so much for joining us. If the listeners want to connect with you and find out more about Macrodesiac, where can they do that?
Yeah, just go on to macrodesiac.com. Follow me at David Belle with an E on the end _. And yeah, that's it.
And check him out on LinkedIn, and especially his Twitter account is a legendary follow. David, thank you so much. To our listeners, peace, love, and prosperity. And we'll catch you in the next one. Cheers.